Hello, friends. My name is Behroz, and welcome to my channel. Today's video is a recorded podcast with Canada's tax accountant, Aamir Jewani. Taxes are the largest expense for anyone living in Canada, so it's crucial to know how to optimize them. One of the best ways to do this is by having a business. You can start a side business as a sole proprietorship or even as a corporation. This is exactly what Amir Jewani explains in this podcast as to how you can go about saving taxes if you have a side business. If you would like to take an advantage of Amir's services, I will leave a link in the description of this video on how you can reach out to him. Please note, it is a paid consultancy, but I have asked Amir to offer a 30% discount to all the listeners who book a session with him. Also, and more importantly, the money you pay for the consultation can be credited towards future services you purchase from him. So, I highly recommend you book the consultancy call, get the advice, and take advantage of his services to optimize your taxes to the lowest possible rate. But before we move forward in the podcast, I have a special ask of you, which is in case you find any value from this video, please press the like button as this keeps me motivated and helps me improve the quality and quantity of content that I post on this channel. And more importantly, if not done already, please subscribe to the channel as well. On this channel, I post content pertaining to how you can achieve success in your career and build wealth. If these topics are of interest to you, this channel is right for you. Now let's get rolling into the podcast. Amir, thank you for joining again. I've had you before on our podcast as well on the channel where we've spoken about primarily cross-border taxation. But today, the reason I have you here is to talk about starting a business and the compliance and tax requirements with regards to when you are starting a business, you're running a business. And also in that terms, there are kind of two forms, which is one, you're running a business along with your day job, and then which is the case with me, for instance, I have my YouTube business, but I have my day job as well. And then there is a business which is a complete full-fledged business that you have altogether. So I would want to handle or tackle both of them, and would want to learn as an objective of this podcast is how can we go about optimizing our total tax liability if I have a business. But before we get into it, it would be helpful if you can quickly introduce yourself and for us and the viewers to know why you are an expert on the subject. Because I know you're an expert on the subject because I make use of your expertise for my personal income taxes, for my business income taxes as well. And hence would be nice to know if you can kind of introduce yourself for people who are tuning in.
Thank you, Barus. So, my name is Amir, and I run an accounting firm with the name Finaction. We operate in Canada, US, and UAE. In Canada, we focus on, besides individual and personal taxes, we focus on small and medium sized businesses where we provide bookkeeping, payroll, tax filing services. In addition to that, we also provide what is called a fractional CFO service to medium sized customers where they cannot afford a full time CFO, but we provide that service to them on a fractional basis.
Got it. Thank you. Thank you, Amir. And as I've said, every time I needed an advice from you, you've been super helpful and very thorough and detailed advice you've shared with me. So it has always helped me. But let's get rolling into the question I have. First, can you tell me what are the different kind of legal structures that are required for starting a business or setting up a business?
Okay, so in Canada, the most simple business structure is sole proprietorship. The day you wake up, you thought that you want to do a business, you want to sell flowers, you are a business owner, and you own a sole proprietorship. So that it is as simple as that. You don't need to do anything beforehand, and the only time when you would do something is when you file your tax return. That's the very simplest form. But obviously, within sole proprietorship, if you want to, operate under a different name, ideally, a sole proprietorship, the legal name of a sole proprietorship is your own name. Like if I start a sole proprietorship, that the legal name is Aamir Jewani. But I want to, start accounting firm and I want to call it, ABC Tax Services. So then I need to register a business name for that. So that's just what is a front end name for that sole proprietorship, which is more of a business name. So that's the simplest form where you start it as an individual, no, complex requirements. And the key part is that your sole proprietorship is not separate from you. So you file one single return where you would file all your income like T1, and in that T1 only you will include that sole proprietorship income as a self-employment income in a form that is called 2125, which is for a statement of business activities. So that's one form. Second form is corporation. um, Unlike US, in Canada the corporation structure is very simple. It's just a corporation. We don't have too many different kind of corporations. Corporation, the basic concept is it's a separate legal entity. So corporation will file its own tax return, corporation will have its own directors, and corporation will not, and the income and expenses of a corporation will not affect your tax return, personal tax return, which is T1, till the time you do not draw any salary or dividend out of your corporation. So it can coexist with your personal situation, and it will not affect your personal tax return unless you do one of these things, income or salary or dividend. So these are two sides. At one extreme you have sole proprietorship where it's same as you. At another extreme it's a corporation where it's different from you in terms of complexity, in terms of paperwork, in terms of cost. Obviously, sole proprietorship is much simpler, and corporation is much complex. Corporation gives you a lot more avenues in terms of what you want to do, but for a typical small business, um, those avenues doesn't really matter. Um, and in between these two categories, sole proprietorship and corporation, we have partnership. So partnership is essentially same as sole proprietorship from tax point of view. The only difference is that partnership is combination of two or more people doing that business. So let's suppose if you and I create a partnership, Amir Barrow's accounting firm, in that case, and that accounting firm earns, $100,000 in a year. So you will, and we are 50-50 partners. So you will report 50,000 in your T1. I will report 50,000 in my T1. Partnership itself will not have its own tax filing in terms of they partnership won't pay tax. It would get divided into the partners as per the pre-agreed ratio, and then whatever is their tax situation they would end up paying. So in partnership there is a possibility that one partner for the same amount of money, let's suppose you and I get 50-50, but you might have to pay 30% tax on that and I might have to pay 20% tax on that, because that would depend on overall T1 situation for me versus compared to you.
Got it. Very clear. First question I have is, how do you go about registering or opening a sole proprietorship or even a corporation? So both, or partnership as well, maybe all three of them.
Okay, so sole proprietorship is very simple. You don't really need a registration unless you are operating under your own personal name. If you want a name so I would mostly focus on Ontario. So if you want a name for your sole proprietorship, then you get what is called a master business license. It used to be called master business license. Now it's called registration of a business name that you do with Government of Ontario. Um, and that's it. That's all that you need to do. Generic. Now, if you are into a business which requires some specific licensing or some specific permit, like if you are opening a restaurant or if you are opening a convenience store, and let's suppose in your convenience store you are going to sell lottery tickets. So yes, you need to register with OLG, Ontario Lottery and Gaming Corporation. So that's separate. But generally speaking, for a business, sole proprietorship, as long as you decide you are a proprietorship, you are one. If you want a different name, you get that master business license, and that's it. And that master business license cost is like $60. It's good for 5 years. So it's very inexpensive way of starting a business. Compared to corporation, when you want to make a corporation, first thing you need to decide is whether you want it to be a federal corporation or you want it to be a provincial corporation. From tax point of view, that does not affect you much. It will remain same thing whether it's federal or provincial, but it depends under which statute or under which business act you want to register. If you register under the act of the federal government, then it's a federal corporation. If you register under the act of Ontario government, it's a Ontario corporation. Um, some benefits of federal corporation are that if you are in a business that you want to operate in future from multiple provinces and territories, so you can have one corporation and then this corporation can have extra provincial license from other provinces and territories. Ontario corporation can also do that, but then at the end of the day it's an Ontario corporation with an extra provincial license in Alberta, BC and all that. So maybe if you have a Canada wide view that might help, but generally speaking it's there's not much difference for, especially for a small business. It doesn't make any difference whether it's federal or provincial. In terms of administration, in terms of making changes like change of address, change of director, federal is a bit easier to handle compared to provincial. In terms of cost, federal is like the government fees is $200, provincial it's $300. So again, not much of difference in that part, but that's the first decision you need to make, whether you want a federal or you want a provincial. Next step is you go to the respective website of those federal or provincial government. That's one reason where people often go for federal, that federal is easier to form on their website. For provincial, lately they have made it easier for people, but maybe few years before, um, if you have to open a provincial Ontario corporation, most likely either you would go to Service Ontario to get it done, or you have to use a third party intermediary to get it done. So that was a bit more expensive. So yeah, so whatever you decide, just go to that website, file your articles of incorporation, and then you would get a confirmation with a corporation number. In Canada, the unique part is that you can open a corporation with a number and without a name. So that would mean it would be 123 Ontario Inc. I mean, they would assign the number, but it could be, and if you are not sure of the name, or in future you might want a different name, or for now you just want a number, and later on, let's suppose you decide, okay, I want to open a restaurant, but right now I want to open a corporation so that I can do expense within that corporation, but I'm not sure if I'm going to open a Chinese restaurant or an Indian restaurant or a Pakistani restaurant, and you don't want to name it yet. So that's where it makes sense to get a numbered corporation, because that's just a number, and then you can decide the name later on and just like we can get a master business license for individuals for sole proprietorship, we can get a master business license for the corporation as well.
Got it. So, what's the benefit of then provincial corporation?
Not much of difference. Not much of difference. It's the same thing from tax point of view. Only thing where I would prefer, one difference is there, by the way. Um, Legally speaking, the information of director and registered address of a corporation, whether federal or provincial, is a public information, right? So when you form a corporation and when you give your name as a director, one of the things that you sign up to is that your name associated with that corporation as a director is a public information. For federal, it is as public as you can just search on internet and you will find it, right? If you go to Industry Canada website, you can search the name of the corporation, you will find the name, who are the directors, what is the address. Um, Ontario, it's still public, but it's not that public. You have to request for what is called a corporate profile report, which is around $40-50, and then you will find that information. So to some extent, it gives you a privacy that every random person is not just searching for your name and finding what corporation you are associated with. Unless they make an effort, they get the report.
Got it. Okay, let's come back to sole proprietorship or partnership. Is it also a limited liability setup or no?
No, no. So one thing we have to consider when we decide, besides other factors we'll discuss later in the video with respect to the tax aspect, one aspect to consider between sole proprietorship and a corporation is liability. So unlike US, we don't have a concept of a limited liability sole proprietorship here in Canada. So if you are a sole proprietorship or you are a partnership, for partnership we still have what is called LLP, but that is on in a very specific cases like professional lawyers and all that who use those LLPs. But typically for an unregistered partnership or unincorporated partnership, and for a sole proprietorship, it's a unlimited liability. So which means that all the owners of that sole proprietorship or all the partners of that partnership are have unlimited liability. So one of the factors which might be a decision making factor for you to decide whether to go for a corporation or not may also be the work that you are doing, what kind of liability it involves, right? Let's suppose if you are selling toys, kid toys, so there could be a risk of choking or something else wherever you think that people can sue you, or you could have that kind of challenge, then probably it's better to go for a corporation.
For a rental property, should you have a corporation or should you have a do it from your sole proprietorship? And I'm not just asking from rate point of view, tax rate point of view,
Mhm.
but any point of view on that? Any thoughts?
Okay. See, your first property should obviously be your personal property. The reason, and we are talking about residential properties, right? So your first property should be your personal property, because in Canada, the largest tax-free asset you can own is your principal residence, where you don't pay any capital gain, right? So and you will be living there. So no doubt that should be your personal property. After that, if you are growing a portfolio of properties, then you need to consider what's your long-term view. If your long-term view is really to get deep into investment into real estate, and have a portfolio of properties, either you buy, sell, or you just keep it on rental basis, then corporation would make sense if you eventually grow out of more than 5 properties, because until it is less than 5 properties or less than 5 employees, it is not considered an active business. And if it is not active business, there it's tax disadvantage. I won't say there is no tax advantage, rather it's a tax disadvantage. Generally speaking, the laws in Canada discourage investments within corporation, because then people can use it as a way to hold money within the corporation, not to take it out and invest directly. So the way they tax investment income is such a way, that's called the principle of integration. So the tax laws are made in such a way that if you do an investment, ideally speaking, if you do an investment within a corporation, you would end up paying same tax that you would do when you are an individual. Now that's a theory. In practical, government wouldn't know that you are a person with a 30% bracket on a personal level or not. So they would assume that you are at the highest bracket. And that's why the tax rate for investment activities in the corporation is more than 50%. So obviously with that 50%, it would not really make sense, to continue doing it if you have 1 or 2 properties. The real benefit is when you cross 5 properties, and then you can be considered as an active business income, and you pay the lower tax rate, which is 12.5% on that corporate income. That's where you get the benefit. So if you really think you are going to reach that 5 property milestone or 5 employees, those employees should be related to the property. I mean, you cannot say that, okay, I have a convenience store, I've got 5 employees, and I will buy another property within the same corporation. That doesn't count. 5 employees related to that state of. If you think you will reach there sometime soon, in few years, go for it. The benefits are much more. But if you think you would not really do it, you are just testing it out, then probably it doesn't make sense, because eventually to transfer that property into personal name would be expensive in terms of land transfer tax and other documentation and all that.
Got it. Okay. And talking about sole proprietorship, let's come back to it, which is in case of GST filing, is if I'm collecting GST, how does that work?
Okay, so
Sorry, मुझे फिर से पूछना है. And in case of sole proprietorship, in case I am collecting GST, how do I go about filing for the GST?
okay, so let's take a step back and start from the fact that when and how you need to register for GST if you are a sole proprietor. Well, if you are sole proprietor of corporation, doesn't matter, the rules are same. Um, if your sales crosses 30,000, that's the threshold, then you have to register for GST or HST, whatever is called in your respective province or territory. The criteria is either in last consecutive 4 quarters, you some of that sales in last consecutive 4 quarters, including current quarter, if you cross that number, then you will register for GST or HST. And once you are registered, then that technically means you are acting on behalf of government to collect that GST or HST while you are selling your whatever you are selling, right? So that's not your money, that's the government money, you are just collecting it. As an incentive for you to collect that money, government gives you a leverage that while you are doing that, whatever money you are paying as GST or HST to your vendors, you can deduct that. So let's suppose I sell a shoe for $113, including it. I sell a shoe for $100 and $13 is HST, 13%. So I would collect $113 from that customer, and the same shoe I bought for, let's say, $80. So 13% of HST might be, let's suppose, $9. So and if that is the only sale I've done in the year, so I my sales is $100, my cost of goods sold is 80, so my profit is 20. So you see, I did not include the HST collected or paid in all of this. So my sales and my expenses are independent of HST. The HST I collect is my liability towards the government, my liability which I need to pay back to the government, and HST I paid while buying the shoes. That was a reduction in that liability. So at the end of the year, 13 minus 9, I would pay $4 to the government. So that's how HST operates, and that's where we see a lot of confusion for the new business owners. When they think that at the end of the year they have to pay a huge tax bill in terms of it. So usual, talking from my experience, usually when you are a new business, in the first year you hardly have, depending on the business, but generally speaking, you hardly have to pay corporate income tax because your tax rate is, because most likely you won't be making profit, significant profit. And there are ways to reduce it, obviously. So corporate income tax is not that big of a number, and it's anyways 12.5% of your net income after all your expenses. But the real number which really hurts the business owners or where they find a cash crunch is HST, because that is on your entire sales and that does not depend on whether you make a profit or not. And sometimes that surprises them that I did not make a profit. Why I'm supposed to pay that much HST to the government? Is because the money that you collected on your sales, which came into your bank account, was not yours. You thought it's yours, you kept it in your account, or you used it, rather, you used it for your working capital, and now it's stuck in inventory or receivable or something else, and now government is asking the money back from you. So that's why it's important, and that's my advice to most of the new business owners, that when you are, registering for HST, make sure to set aside some amount. That some amount would depend on the industry. If you are selling goods and you are buying those goods with HST, probably that some amount would be much lesser percentage of your sales. If you are in a service industry, let's suppose you are a hair salon, so your major cost is rent and your major cost is payroll. On payroll, you don't pay HST. So effectively, if you are collecting 13% HST, you might end up paying 8% or 9% or maybe 10% to the government back. So I suggest them to keep some percentage of their sales as set aside as HST that they would end up paying. Generally, when you register for HST, again, whether it's a corporation or proprietorship, doesn't matter. Generally, when you register for, you call CRA to register for HST, or you do it online, it asks you that what should be your filing frequency, right? Sometimes people select, I mean, you can select monthly, quarterly, or annual, right? Um, Quarterly is not mandatory until your sales cross $1.5 million in a year. So when you are just starting out, obviously you can keep annual, and it is recommended to keep annual because when you are a new business, you would not be really on top of your mark in terms of your bookkeeping and everything. If it is quarterly, so first of all, you have to comply that 4 times, and any delay might result in penalties and interest. So first of all, you have to do it 4 times, and secondly, you get only 30 days after the quarter end to file that, right? Normally, let's suppose your month ends on 31st of March. You might get the bank statement, the PDF statement for reconciliation by 7th or 8th of April. Then you might get busy in some other thing, and then you have to file your HST by 30th of April. So it's not good enough time, especially if you are a small business, your record keeping is not really real time. It would cause trouble. So that's why we suggest to go for the annual option. And in annual option, you get 3 months after your year end to file. So that's a good enough time to catch up for all that stuff and plan your cash flows and everything accordingly. Nobody's stopping you from payment. So yes, you can keep your filing annual, and you can still keep on paying certain amount to the government if you choose to do so. That's not a problem, but filing should be annual, at least for the new businesses, especially in the first year. Only when they cross 1.5 million in sales, when quarterly filing is required. And likewise, when you file your HST for the first year, if it is more than $3,000, then they ask you to pay quarterly HST. Again, not filing. They are asking you to pay quarterly HST. So first year you get that choice. So I would suggest to avail that choice, manage your cash flows, and then from second year onwards, if your HST is more than $3,000, then obviously they will ask you to pay quarterly. So you can start paying quarterly then.
Got it. Makes sense. Thank you. This was helpful. Now let's talk about the tax rate. So, what is the tax rate in case you are incorporated, and what is the tax rate in case you go for sole proprietorship? Because I think that could be a measure as well for you to decide which one to choose.
Okay. So sole proprietorship, there is no fixed tax rate. It would depend on where do you stand. So let's suppose, like we discussed in last few videos as well, that in Canada, your personal tax rate is a bucket. So you have a bucket, and let's suppose you fill that bucket halfway through with your employment income. So every next dollar or every next drop of water going into the bucket is above that level. So likewise, if your employment income is 100,000, so your first, 15,000 is 0%, next X amount is 15%, then 20%. And let's suppose the last dollar of your employment income was sitting at 30%, and the only other income you have is that business income. So that would be at that 30%, right? And it may go up to the next bracket as well. So it really depends on what is your marginal tax rate in your personal situation. That will decide, what tax you are paying on your business. Also, not to forget that this self-employment income is subject to CPP also. Not just employer portion of CPP, not just employee portion of CPP, but also employer portion of CPP. Having said that, if you have already crossed in your employment income that threshold of 66, 68,000, every year that amount changes, but whatever is the maximum pensionable amount, if you have already crossed that, then CPP doesn't really matter for you. Then you have to really worry about the income tax only. So the rate would depend on where you stand. What is your marginal tax rate after all your other income? Whereas in terms of corporation in Canada, the rate is roughly 12.25%. I say roughly because um, it varies from province to province as well. And there's a big caveat to it that 12.25% is after what is called small business deduction. Okay, so there are certain criterias which is generally met by most of the small businesses, and after meeting those criterias, you are eligible for 12.25. Other besides other criterias like it should be a Canadian controlled private corporation and other stuff, the most important criteria is it is only up to first half a million of profit. So the short answer to your question would be first half a million, 12.25 in Ontario. Other provinces would be kind of similar. And after that first half a million, remaining amount is taxed at 25, 26% mark.
Got it. So it seems if you are making profit, it is better to do a corporation because your tax rate will be lower versus the individual tax rate, because tax rates usually the individuals that are paying is typically higher. And if your marginal tax rate, so let's say if your marginal tax rate is above 10 or above 15, which is typically the case, then it is better if you're making a profit to open a corporation. But if you are making a loss, then it's better not to open a corporation and let it be a sole proprietorship, just from tax purposes or tax calculation point of view, because then you can bring your T4 income down and hence end up paying less tax. Does it make sense, or would you agree?
Generally it does, but we also have to. So obviously, when somebody comes to me for this advice that whether I should incorporate or I should be sole proprietorship, I'm just starting out. My first question is liability, right? Because liability takes over all the benefits you make from tax if there's serious liability issue. So depends on what you do, and if you think there could be a serious liability issue, then probably go for corporation. The benefit is not worth taking that chance. Once we clear that stage, if you are indifferent from the liability point of view, then the next aspect would be um, where do you stand from the marginal tax point of view in your personal tax return, and how confident you are that you are going to run that corporation in the longer run, or you are going to run that business in the longer run, right? So if somebody says that, I'm just trying out, I'm testing the waters, I would say, okay, then go for the sole proprietorship, even if your marginal rate is lower, but still, why to because not just creating a corporation is a process, dissolving a corporation is even complex process. And to surprise for surprise of some people, I charge more for dissolution of corporation than creation of a corporation. The reason is then, when there is nothing, it's easy to create something. But when something is there, then you have to close the account with CRA, you have to close the bank account, you have to close with Ontario or federal government, whatever it is registered with. Plus, you have to make sure everything aligns on a particular date and the balance sheet on that date is zero. So there's a lot more work to do when you're dissolving the corporation. So that's why I say if you're just testing the waters, you are not really sure, go with a sole proprietorship at least for a year. It wouldn't hurt. And then if you think that that's a long-term thing, then go for corporation. So that's another thing. Your viewpoint. If you are testing waters or you are sure about it, and last is obviously the tax point of view. If you are someone who is sitting on a 40% tax bracket and you have to do something, then I would say, okay, go for the corporation. Why to pay 40% on that if you foresee making a profit from get-go? So usually that is a factor of whether you are, let's suppose a tax filing service. So if I'm just starting out and it's a tax filing service, and let's suppose if, I have a day job and I'm in a 50% tax bracket, I'm CFO of a big company, I'm just doing it as a, side business and just testing out and all that. I may have time, I may not have time. So in that case, I know I will have profit, right? So if I want to pay that 50% to test out the water, if that is the cost I'm okay with, go for it. Otherwise, if I'm serious about it, that no, I'm going to do it. Eventually, one day I want to transfer to my own business, leave this job, and I'm going to do it as a serious effort. I would hire people and do it. But still, I'm today at a 50% bracket. So I would say then go for the corporation because you are already at such a high bracket that the tax saving is much more than the cost involved with dissolution of the corporation or all that paperwork and all that. And secondly, it's one of those businesses where you can make profit from get go because your cost of doing business is very low compared to someone who says that I am going to do an Amazon business, right? I would buy inventory and within Amazon, particularly, I'm going to go for a private label. So I'm going to do research, I'm going to find this and that, and then I will buy inventory, I will ship it to Amazon FBA, and then, all that setup. So I know that most likely they are going to end up in a loss in the first year. So even if they are in that 50% bracket or 40% bracket, I would say do it as a sole proprietorship because you will have loss. So better, save your taxes for this year, which will help you with from cash flow as well that you would spend on Amazon. So yeah, so in that scenario, I might suggest to go for the corporation. But having said that, even within a corporation, if you are making a loss, and I mean, when people make a loss and it's their first year of the business and it's a corporation, they say, "Oh, I made a loss. Would I get a refund?" That's a thinking you have from your personal tax point of view. That if uh, I get a refund if I'm really not making money, that's not really a refund. And more often than not, either that's a subsidy which government is giving you, GST credit or this or that, or that's like carbon tax credit which you would get anyways, or that's refund of your additional tax you paid on your salary. For example, you were just employed for 6 months, you paid higher salary, and eventually next 6 months you were not employed. So it's not a extra money you are getting, it's just that the money you paid a bit more that is coming back to you. So people think that in corporation as well, if I had a loss, I would get money back. So unless you haven't paid any advance installment of your corporate tax or HST, you are not going to get that back. But that carries forward and carries back. So the loss you make uh, gets recorded into what is called as Schedule 4 of your tax return of a corporation. So corporation files T2, and the Schedule 4 of T2, it's called a loss continuity worksheet. And within that, it keeps on recording your losses. And the tax laws have very generous time limits in terms of up to what point you can go back and apply your losses, and up to what point you can carry forward and apply your losses. And it goes both ways. So the point is, if you miss out on that, you formed a corporation and you had the losses. In the longer run, you will recover that money. Yeah, so that's something we have to consider.
Early on, you're not decided, you go with the sole proprietorship. Secondly, when you're starting your business, there are typically more losses. And if there are more losses, you again go for sole proprietorship because you can adjust those losses against a higher tax that you're paying on your employment income. If you're making I mean, a good profit from day one, if you're decided this is the business you want to be in, better go with corporation because that way you'll be paying less taxes in corporation.
Yeah.
Now, talking about taxes, how can I, and let's talk about the scenario where I want to start with sole proprietorship first because I want to optimize taxes. I want to bring taxes down, which is only possible if there is a loss. So, how do I go about in an all legal and right manner show losses through my initial business? What are the ways where I can record losses even if I'm generating revenue? So even when I'm selling whatever services I'm selling, let's take YouTube as an example. I'm making videos, I get AdSense income, I do coaching calls, I make some revenue. So how do I go about making or showing a loss in all legal ways?
See, in all legal ways, there are some direct costs which you anyways would have, right? So that in your case, obviously, YouTube, I don't think there would be much of a direct cost, as in, yes, your camera is a cost, which is equipment, and you might have other costs as well. But apart from that, so direct cost is a no-brainer. Obviously, whatever is required to generate that revenue, that's a direct cost. You will obviously use that first. After that, then there are some costs which are kind of a shared cost, especially in the scenario like you mentioned, where you have some work, a day job plus you are doing this, and that shared cost is typically like you are using home office, or you are using part of your home for your studio. You might be using your vehicle for, depending on what work you do, you might be using vehicle. In case of one of my client who was selling on Amazon, so he was using his basement as a storage. He was using his home office, plus he was using garage as a storage. So he had a much bigger expense to claim on that part. But technically, it was his own house. So these are called shared expenses, or expenses which are, so you anyways would have had that home. You anyways would have had that vehicle. It's just that because you are doing business, it allows you to take a reasonable portion of your expense towards business, and which makes perfect sense. Even the tax preparation fee you pay to the tax preparer, a portion of that can also be applied to that, if you have one of those. So if somebody comes to me who is just an employment income, my the fee that they pay to me, it cannot go anywhere in their tax return. But if somebody comes to me who has a rental income, or who has a self-employment income plus employment income, and the fee they pay to me, I can apply some portion of that fee. In fact, a big portion of that fee, because really that's where I charge more. So a big portion of that fee towards the professional and legal expenses. So yeah, so that's the example, like where so typically most biggest those shared expenses are your house, where you can claim home office expenses. Most of the businesses, I think, should be able to claim it, but the requirement is then you should not have any other place of business, right? I mean, if you're running a childcare business, there's a physical childcare which exists where people come to drop their kids. You cannot say that my home office, I also have a home office because someday I work from there, so that is my home office. No, you cannot claim that. But if you don't have any other place of business, or if your home is the place where you ordinarily meet your customer, or where you perform your duties as an administrator, provided you don't have any other place of business, then it could be considered home office. So first criteria is it should be eligible to be in home office. The next criteria is reasonability, right? By default, if some place is dedicatedly used for the business, whatever portion of that it is for your um, overall livable area of the house, you can, that portion you can claim, and you can claim that portion for your utilities, for your internet, for your general repair and maintenance. I mean, if you are for example, if you do something in your backyard, right, but you are not using your backyard, so obviously that cannot be claimed, but general repair and maintenance can be claimed. Roofing of the house is for the entire house, it's not specific to one area. So that could, so repair and maintenance, utilities, interest, that is the biggest cost these days, the interest you pay on the mortgage, the insurance, property tax, all of that to a reasonable portion percentage can be claimed as your home office expense. And likewise for vehicle as well. For vehicle, typically CRA or IRS gives a mileage per kilometer that, okay, you can claim. Last I remember it was 72 cents per kilometer. So that's the easier way to claim it, where you have kilometers, you can keep a log of the kilometers, and then you can claim it based on that rate. Or otherwise, you can go by a detailed method as well, that I did all of these expenses, and this was the percentage of the vehicle I drove for the business, and I want to claim it. So your home office, your vehicle, your these are two biggest shared expenses you can claim. Obviously, your phone as well. In vehicle, I would mention that going from your home to your place of work is not a business use. it is commute, right? Both in Canada and US, it is not considered as a business use. Yes, from your place of work, if you are going elsewhere to buy something for your, again, going back to the example of the daycare, if you're buying some grocery for the daycare or something else like that, then yes, that is a eligible expense. Or if you are going to meet someone, that is an eligible expense.
Got it. And in case of car, if it I fully own the car, if it's on lease and finance, or I own it, how do I expense it?
Okay. So, okay, coming back to Canada, in Canada specifically, government has requirement certain caps on how much you can claim on the car, depending on if you own it or if you lease it, right? If you lease it, they have a monthly cap, which last I remember is 900 odd something per month that you can claim. Uh, if you own it, the maximum is 36,000 that you can claim for the whole value of the car. So sometimes it's better to lease where you can negotiate a longer term and your monthly is much lower or is close to 900, and you would be able to claim a good deal of it. I know someone who claimed he had a luxury car and he get a longer tenor, and his the total monthly payout was 1200 and he was able to claim 900 something out of that. So depending on how you negotiate your lease, you might be better off if you can negotiate a longer lease, and if you want to keep that vehicle for a longer term, then possibly you would be able to claim that. But at the same time, um, it should be a capital lease. It cannot be an operating lease. Um, लीज वाला कैपिटल ऑपरेटिंग वाला हटा देना. So yeah, lease at sometimes is better. If you are financing the car, you have to keep in mind, excluding zero emission vehicles or electric vehicles, for the regular vehicles, the cap revises every few years. Right now it's 36,000. So if you buy a car for, let's say, 50,000, you can depreciate it over the years. So in lease, it's very simple. You expense that lease and you just move on. In case of buying a car, you depreciate it over the years, and you can depreciate only up to 36,000 in this case for tax purposes. So that's where we have cap. Until 2023, you could depreciate 100% of your, sorry, until 2022, you could depreciate 100% of your zero emission vehicle if that is less than 55,000 for the full year. And now that has changed, and now it is okay, sorry, मैं दोबारा बोल देता हूँ. Until 2023, you could depreciate full value of your zero emission vehicle if that is up to 61,000. But now they are reducing it to 80,000. It will reduce further and so on and so forth. So yeah, zero emission vehicles are a bit different. Government wanted people to use that more often, so they had incentivized it. But generally speaking, for your cars, it's a depreciation where you claim that expense back, and the cap on depreciation is typically 36,000 for the regular cars. But this is for the passenger vehicles. If you have something which can only be used for the business, like if you have that tow truck that you use for towing the car, and that's your business, then you can depreciate it fully. Doesn't matter the amount of the value of that vehicle.
Got it. I think the merit is if you are able to allocate as expenses items which you would regularly buy or consume in any case, but now you have a business, and in some way I can make a case that this is a business expense. Let's say I'm living in a house, I'm already paying the rent, but suddenly I have a studio in my basement and I start to charge this part of the basement as part of the expense. I already have a car and
Mhm.
suddenly I have a business, so I start charging. So I think that's where you start making the benefit. So talking about that, I go
Mhm.
with my spouse on a, a dinner, let's say twice a month. If
Okay.
I discuss some business during that dinner, can I charge that dinner as expense or not?
Okay, a very interesting case. I saw that example on a Facebook group a few days back. Somebody said that I went to Disneyland with my wife, who is also director on my company, and over there, because at home we are usually busy with our household stuff, house chores, and we can't discuss business. So I went to Disneyland, and then we discussed about the business over there. And from there we called, and that meeting resulted in firing one of the customer who could have caused us a potential loss. And from Disneyland only, I called my lawyer and I called my one of my sales guy and this and that to get their input. That was a genuine business meeting happening out of the Disneyland. So can I claim the everything related to the travel and the tickets of the Disneyland and all that stuff? So no, that's an exaggeration. That cannot be done. So again, I think in all these scenarios, the bottom line would be what is regular or ordinary for that business, that kind of business. Because see, when we talk about CRA, they look at thousands of business or maybe more millions of businesses over the years, in your industry, in different industries. So they can make a very reasonable guess of what is reasonable or not. We are in a situation where we can only make a guess. And as a taxpayer, you would look at only your business, maybe a few friends you know. As a taxpayer, I might have seen maybe 4 or 5 times more businesses than you do. And but as a CRA, they know a lot more, right? So I would say the criteria should be what is reasonable and ordinary for that business. Because CRA, if in case of an audit, CRA has got a lot of leverage in deciding that. And when they are deciding that, honestly, it's difficult to make a case if that was not a genuine thing, right? So before going to that expense, first part would be where CRA or IRS would try to look at your business from that point of view, is whether that was a hobby or that was a business, right? That's the one major bifurcation they do. If it is something you have kind of half-heartedly done once or twice a year, or you are a good photographer, you do that. Maybe once or twice you would have sold one of the photos, but otherwise, you are a wildlife photographer, you just do that out of your hobby. So based on the facts, it's a question of fact. There is no hard line, but based on the facts, they can conclude that it was a hobby, and if it was a hobby, nothing is deductible. Even the camera which was directly related to it and other stuff that might not be deductible if it's a hobby. So first thing, it has to classify as a business. There has to be a serious effort to make a profit. You might not have made the profit, but there has to be an effort. Like for example, I'm selling tax services. So one effort could be, did I do I mean, if let's suppose I'm doing tax services, I do tax filing for 5 of my friends, $100 each, and I make $500. And I am claiming my home office, that I tried to market and this and that, and I'm claiming my home office, I'm claiming my vehicle, I went to meet customers, this and that. For 1 year they might agree, but next year again, if I'm making $500 and I'm spending, let's say, $3,000 on my other expenses, and that happens one more year, then they have all the reason to believe it was just a hobby. So your pattern also matters, because when CRA would do audit, it would be retrospective. They would come to you after a few years. So they have a history of last 4 or 5 years to see. So your pattern matters. What effort you are doing. Okay, I might have got the 5 clients, but see, I have a website. That's the baseline marketing. Besides website, I was doing Facebook ads. Besides website, so these are the direct expenses I'm doing for my business to grow that business. For some reason, I was not good enough in marketing, or whatever reason, I couldn't get the client, or at that time I just fall ill, or I had some injury and I couldn't do the work. So that's a separate situation. But the effort should be there to make the profit. That is the one key criteria for CRA. So once they are convinced on that, yes, the effort is made, then they would look at expenses. Direct expenses, perfectly okay. And then expenses like this that you just mentioned, like, I went to a dinner and I claimed that dinner because I went with my wife, and more often than not, they would not consider it as a business expense. In case of CRA, the meal entertainment, so there are few expense heads where the guidelines are very specific, and there might be exception, but generally they go by that rule. Meals entertainment is one of them. Typically, meals entertainment is your meals entertainment with your suppliers or customers, on some occasion with your staff. For staff, there is a condition, like it cannot be just one random staff all the time. It, I mean, the meal office party is one thing, and just one staff all the time is a different thing, right? That one staff happens to be your wife or wife's brother or somebody else is a different story. So meals and entertainment is one category where if they are auditing, they would go, depending on the number, of course. If you have like turnover of $1 million and you have expense of 5,000, probably they wouldn't care. But if you have turnover of 30,000 and your meal and entertainment is like 4,000, then they would definitely look into that. So meals entertainment is one, and anyways, meals entertainment, your tax return is reduced by 50%. So meal entertainment is one where they go aggressively. Travel is another one. travel is where they would go very extensively, especially businesses with lower turnover, businesses that possibly do not need that kind of travel. They would go extensively. That's one of the red flags for them, is if that's a high number in compared to the overall sales. Besides travel, obviously home office, they want to see some, and that's why I suggest what my clients who are using home offices have some pictures. In your case, obviously you have videos to show, so you it doesn't matter for you. But generally, for someone who is doing home cleaning business and he uses his office for home as office to book those appointments and all that stuff, have some pictures that this place was used dedicatedly for the business, have some documentation that what part was used and all that stuff. So home office is another item where they would go extensively into that. So these are 3 4 items where you have to be reasonable and a bit cautious, I would say. One off, okay, that's fine, but not something on a regular basis as a pattern.
Got it. And the other two I wanted to ask you is mobile bill and internet. I already have an internet. I have a mobile bill, but now I have a business. Can I charge all my internet and mobile bill to my business?
I would say prorated. If you have 2 phone lines, then you can say, okay, this one was personal, this one was business. If it's one, then I would say prorated. There is no way you can prove that I am so antisocial. Nobody calls me. I don't call anybody. It's just because of business I'm making all these calls. Or otherwise, I don't need to know, or I don't do anything on internet except, logging in and doing my YouTube videos. So just prorated. And CR is quite reasonable, or IRS is quite reasonable in terms of your proration. But then they should not feel like you are trying to fool them. That's the bottom line. You should not make IRS or CRA computers unhappy. That's what one of our trainers used to say, that you should not make the computer unhappy, because before it goes to an individual, it goes to a computer these days, right? And if the ratios are too high from what average they have, there might be some flags. So make the computer happy and you are good.
Of sole proprietorship, let's say I pay my kids money to help me with my business. Can I charge that?
Yes. You should have a justification. You should have documentation to prove that they actually work. That's it.
Okay. And
And they should be
last,
legally allowed to work.
oh, really? Legal
I
age.
mean,
So
again,
I'll
it's
give you
not
a
a tax
scenario.
question.
I'll give you a
Sorry.
scenario. I'll give
Yeah.
you a scenario. I asked my daughter to edit my videos and I pay her $50 for editing a video. Is that something I can expense? And she is 13 years old.
Should be okay. I assume that's not a legal age to work, but again, that's not a tax question. That's for some employment lawyer to answer. But usually those things trigger when, you know, it's just a side hustle your daughter is doing, right? It's just like selling lemonade on a hot day. It's similar to that. So that should not really trigger any child labor issues. But yeah, if you have a toddler or you have an infant and you are saying that he's helping me somehow, so that's not reasonable. So yeah, you can pay your kids as long as you can show that they have done some work.
But does that generate any tax liability on my kids then? Which is they have to pay any tax on the income they've earned or no?
You have that threshold, right? 15,000. So if it's within that, that should be fine.
Got it. And one last question which I have is because you talked about travel, and I'm interested in specific situation I am in, which is I book a vacation with my family. I go there and then I shoot a video related to my vacation. Here I am boarding the plane. Here I'm flying to Istanbul. We are in Istanbul. We are eating food in Istanbul. This is the mosque. This is the streets. And we make a video. I put it in and then I come back. Can I charge my flight expense, my hotel, and my spouse as well, assuming she's part of the video as well, to the business or no?
Okay, so the first criteria is if that is the only video you made throughout the year, that was your hobby, not a business. So no. If you are like a regular person, who a regular YouTuber, and you have that AdSense account, you earn part of your earning through YouTube, then possibly yes. But then next question would be, generally I see, I mean, if I'm that IRS or CRA person, I would say, I have seen your channel. Generally, you talk about personal finance. What does Istanbul have to do with the personal finance? So then that's another thing. You could talk about personal finance in your basement. Why did you have to go to all the way to Turkey? So that could be one of the question. If it's a travel vlogger, it's no brainer. But at the same time, see, most of these rules written by tax codes or rules by CRA or IRS, they are years or decades old, right? At that time, influencer was not a thing, right? So now there's a lot of discretion involved when it goes, because it is involved on both sides. On one side, the taxpayer sometimes goes overboard, by claiming too much. On sometimes, the regulator might go overboard, and they use your discretion. I think that is too much. Unfortunately, there is no um, clear way to, or objective way to say that, okay, this is the point where which you should not cross. So it's more of a trial and error. So depending on what you are doing and what extent you are doing, um, we should make it reasonable. And if we make it reasonable, they are reasonable people, right? For example, if I'm going for if I live in Canada, if I have a tax training related to US, and I do US taxes, and I am required to have a certain number of CPEs. So I went there, I attended the training. However, I obviously brought my kids and wife with me as well. We stayed in the hotel. Um, so I can make a reasonable estimation that, okay, this training is not related to my wife and kids. I stayed in hotel for 5 days. Training was for 2 days. So maybe 2.5 days, 3 days I can claim as a hotel. I can claim. If I took the flight, I would maybe prorate some part of my flight as well. So proration is important. That's where you would be able to convince your, if there's an audit, that okay, you try to be reasonable. Now your reasonability might be different from someone else's reasonability, but at least you tried. But if you start putting everything in it, then there's a problem, because tax law goes to the extent, especially for those influencers, like the law says that if you get any kind of benefit, that is your income. So if, let's suppose, those influencers, they get to use some luxury cars because they are influencers, and they get that luxury car to be used for a week so that they can show on their Instagram and the car sales increase. IRS can say that you got a benefit, so that's also your income. Yes, you record your expense, but that is also your income. Besides what you got from the car dealer, you got a benefit of using that car, and you might have used that car for other things as well. That this luxury car rental per day is X amount. So they can also go to another extent to become unreasonable. So yeah, if you remain reasonable, they also try to not to go to that length.
Thank you, Amir. Thanks for joining. This is wonderful. All the information that you shared, this was great. And we'll be calling you again, as well as on the side conversations we were having. I think there is merit in making a separate video on how to optimize taxes if you are, let's say, an Amazon seller or a online e-commerce seller. And secondly, I'm more interested as well. I have other questions as well related to YouTubing. So, how can you optimize your taxes if you are YouTubing? How can you bring them down, and in all legal ways? But thank you. We'll call you again for those topics as well. And thanks for joining.
Thank you.